self-introduction. My name is Mark, and right now both of us are sharing the same mobile device because of sound quality. I was a Web2 founder from 2013 to 2019. I had a bit of an exit, and then I was lucky enough to be an early investor in Polygon. Subsequently, I have been in the space mainly looking for DeFi, GameFi, as well as deep-in projects. And I met up with ChainsAtlas co-founder, Mr. Hanken, who's right next to me, in several major conferences around. And I believe that right now things in the space are looking pretty bullish. Let me hand it back to him.
Hi, everyone. I have no idea what you guys heard because there were some technical issues, as Mark said, with the mic. So once again, for everybody that didn't catch it earlier or if it didn't go through, welcome to Linking the Blogs, the ChainsAtlas Podcast. Today a bit more chaotic and a bit more on the spot because we are actually, as Mark said, in his place, one of his restaurants where he has a bunch of them across Southeast Asia. The actual amount is always fluctuating a little bit, but I can only highly recommend. More about that later. And later we will have our own side event for Block Mountain with ChainsAtlas with a quite exciting announcement. So stay tuned on our channels. You already talked a little bit about how you got here and into the space. Let me ask another question. What are you generally interested at the moment in Web3? We're in a quite interesting situation. There was a bull run that didn't look like the last bull runs, really. There was heavy involvement of big institutions. The ETF for Bitcoin was coming up in the beginning of the year. And as an investor, how do you see the current situation? What are the big narratives? What would you personally be interested in looking deeper if you were to make an investment decision?
Yes. Okay. So that's quite a big question. The thing is that what are the big narratives happening this time? It's quite clear to me that right now we're in a what I would describe as a meme supercycle. So there's quite a large amount of memes actually being minted with the success of Solana and what seems to be a lot of volume appearing in Base as well. Seems to be the most stable Ethereum L2, even though first love was still Polygon. And also, let's not forget the Trump pump. And so that actually brought a lot of new liquidity into the entire crypto ecosystem as a whole. The other major narrative I see is basically the AI or agentic narrative. So if you guys are not aware, there was a particular platform known as Virtuals, and their native coin actually pumped something like 6,000%. Now it's a little bit of a traceback, but it seems that there's a lot of new AI or AI-centric projects that have launched tokens in their own right. So like along the lines of ChainsAtlas event later, which is AI meets blockchain, this category of projects, frankly, I'm still very skeptical about it because when I first started investing in the space, my first love was always DeFi. Now, DeFi made a lot of sense because the fact is that we are trying to move away from institutions. And what has been happening in the last year, we've seen a lot of institutional money actually just come into the. So you got BlackRock, Larry Fink, obviously Michael Saylor and MicroStrategy, and not a large amount of VCs are coming in at the moment. And the creation of the ETFs of various assets, most remarkably Bitcoin and Ethereum, that actually has changed the landscape slightly. So the fact is that now we are seeing the same, like for example, anybody who does trading, you're familiar with the one-off trading pattern, where large institutional investors, they tend to accumulate in a certain a method, and retail investors become their exit liquidity. We're seeing exactly the same patterns being repeated in the charts right now. And with the advent of President Trump right now, that meme coin that he doesn't confirm or deny that he launched seems to have actually added 14 billion market cap into the entire space. I'm not too sure that retail investors that actually went into that are actually having a good time because it was 14 billion market cap, and now it's very sad. So the thing is that part of the question is that what would I invest in right now? I would actually not go hard into memes at the moment because it's very difficult to back the right meme. You see, if you look at pumped up fund, right? I mean, it's a very good mechanism whereby only the memes volume actually get liquidity added to them, and they go on a bit of a run. So the thing is that identifying this is difficult. I mean, I personally have tried doing three things. I've tried doing copy trading using, I use a tool called Maestro. It's pretty good, actually. So there's a free, and it actually allows you to track other wallets on Base Chain, Solana, BNB, even Ethereum if you feel like it, although the gas fees are still rather painful. You can enter positions which other successful traders have entered in specifically for memes. So, for example, if a pumped up fund token goes live, it has liquidity added to it, and the particular wallet which I'm following, which may be a successful trader, I use a stack of tools. One is called Screener, and I list them by top traders. And normally you want to filter out the traders who actually have any bias, because those are likely insiders. They didn't buy the tokens, it was just into them, or they transferred them from some other mysterious wallets, which also, it's alluding to an insider play. So, but those guys who are genuine traders, ones that actually entered after like block zero, and they know their exit points, they basically know how to do technical analysis. Not that you can do much technical analysis on meme coins in the first place, but they know when to get out. And so those guys are worth following. For you guys listening out there, if you actually want to copy stack, it's Stack Screener, and I use i.so. So using those two, you can see how successful the meme traders are. So that's actually one major method out of three I'm going to describe. The second major method is simply you go fundamentals research. Like, for example, nowadays memes don't run in isolation. Like, for example, you have Trump, right? And now you have son of Trump, you have dog of Trump, you have ex of Trump. The thing is that now you actually have what you call meme derivatives. And this is not new. So when Doge launched, you ended up having Shiba Inu, and then from Shiba Inu, you ended up having Floki Inu. So technically speaking, if we want to look at it in terms of a subcategory, this is a derivative of a meme. So most likely, the derivatives of the meme sometimes outperform the big one because there's not much alpha left following the big one. Because once all of the big wallets are in, once the institutions and once they get listed onto CEXs, which we'll talk more about, I guess, later, then basically you've missed the boat. You don't have much of a upside. In fact, a lot of retail investors, they tend to hear about memes only when they become famous, and that's a bit too late. So my suggestion is method number 2 is to actually do meme derivatives, and that means do a little bit of research. And some common sense. I mean, I think I misspoke. Some best practices I recommend to do is firstly check whether the token in general has a freeze permission, whether the person that minted the coin can freeze trading. That's a big red flag. The second thing is there accumulation of a lot of the meme coins in very few wallets? That means can a large holder dump on you? Like, most likely this is usually the developer himself, and in terms of bad actors. And the third thing to watch out for is that is the liquidity versus the market cap. Now, this is one thing that most retail investors don't look at. There's no one size fits all ratio, but the truth is, if their liquidity is too low, for example, you have a market cap of $100 million, but you only have like a 1 million of liquidity. That means essentially only $1 million worth of the meme coin can actually be sold, and then the rest, everybody else becomes a bag holder. And to cap off before I hand the mic over back to Jan, is the last and final method for memes. I would say it would be to how do I put it? Be careful of the memes which actually claim to have utility but don't. So that is a big one. Now, even the joke is like, if you look at Ape, right, which is a coin which was distributed to Bored Ape Yacht Club, Yuga Labs project, and it's a very famous project, of course. And most of the people who are holding Bored Apes are usually like high net worth individuals. So they actually hold a lot of the supply of Ape. So that is actually an example of a project that actually knows how to give utility to their meme coin. Whereas the vast majority of memes simply have no use other than promoting their community. So let me hand it back.
That's super interesting. I'm not a big trader of my own, to be honest. I do a little here and there. A lot of fun. I wouldn't say I'm hyper successful. Bots are usually outperforming me, but that's all right. That gives me more time. That gets us exactly to the topic of tooling, which you already touched on. And as the title of this podcast today suggests, we'd like to talk a little bit about difference between different exchanges that are out there. For those that might not be super deep into the Web3 field yet and listen into this, there are two main categories: decentralized and centralized exchanges. You mentioned DEX scanner. DEX, DEX stands for Decentralized Exchange. There's CEX, which stands for Centralized Exchange. I like how you call it CX. Many people pronounce it CEX, which is good for a party after a few beer and a few jokes. But that is a very interesting thing because the whole industry started out with decentralized exchanges. That was the only way to get access to the actual coins. If you didn't happen to have friends, buddies that sent some to you and you gave them cash or whatever the other methods would have been. But if you wanted it from somewhere more institutional, and you didn't have access to people in the ecosystem, the only access would have been a centralized exchange for you. There have been various hacks over the time, some in the billions. Forgot the name of the first one, Mount something?
Mount Gox.
Mount Gox was it, yeah, exactly. And later on, there is the concept of decentralized exchanges. Maybe you can explain a little bit of the difference. And also, I hear from your description, you tend a little bit more to the decentralized side of things. Also, knowing you well, that's more your personality, I'd say. Maybe you can elaborate on that a little bit. What's the difference between both and why you think one will probably outcompete the other?
Okay. So what is the difference between a CX and a DEX? Very simply is that a DEX is usually governed by a DAO, a decentralized autonomous organization. Means, and regulators hate this, it means it's basically run by the community and not by any one particular entity that you can pin down. Whereas CXs are run by registered entities. Usually they have a very high capitalization. And most of the time, CXs are, frankly, very deep-pocketed. Let's give a couple of good examples. Like back in the day, if you had Bitcoin back in 2008 or 2009, frankly, there was no way for you to actually exchange your Bitcoin for some other token. The only way for you to do that is take the off-chain, give it to somebody else, and somebody would have to, for example, give you his Ethereum. I think Ethereum probably didn't exist at that point, right? No, not yet, right? So the thing is that the concept of DEXs was simply, they provided an automatic market maker. So essentially speaking, somebody would create a liquidity pool. So think of it in terms of a money changer. Somebody would have it's easier if we explain this in terms of real life Forex currencies. Like say I have Singapore dollars and I have US dollars. I have a liquidity pool, which means I have a bunch of USD and a bunch of SGD sitting with me. And so if my customers wanted to get USD, they would actually have to sell their SGD to me and then take my USD out of my pool. And when that happens, what will happen? It actually increases the price of the USD because the automatic market maker on the DEX would actually increase the price of the USD as less and less of the USD is left in the liquidity pool. Now, the thing about CXs is that they perform the same function, except that they act very much like real life banks. And this is the part I personally am a little bit skeptical about because they also practice fractional reserve. Whereas a DEX actually has to hold the tokens on chain, a CX has the capability of actually inventing money out of thin air. Sounds very familiar, right? Sounds like a bank, right? But okay, so today's master topic was, do we really need CXs? The things that CXs did play a bit of a pivotal role in early crypto adoption because they actually brought the access to people who were off-chain and gave them the ability to actually onboard themselves. So onboarding crypto, otherwise known as on-ramping, means that my very first exchange, which I used, I still remember, was Coinbase. And Coinbase was pretty helpful. They actually had articles on what is the blockchain, what was the differences between blockchain. We're not going to go deep into the fundamentals today. We're just going to talk specifically about CXs. But what Coinbase did was actually allow me an easy way to get Bitcoin, Ethereum, and other digital assets into my wallet, and they provided me a wallet because back then I didn't know any better. Like right now, everybody knows the difference between a custodial and a self-custodial wallet, which brings us to the second definition. CEXs basically custodize your assets. And it's a quite famous saying in Web3, especially among the people who are working in that space, like me and Yang, that if it's not your keys, it's not your coins. So that's precisely what happened with FTX, which is one of the most famous CX failures in the entire world. I believe the damage was something along the lines of what, I think 20 billion? Yeah, 20 billion US dollars, which was simply just wiped off the face of the earth. And most of that was, it was revealed to be like fraud, and obviously a lot of the volume which it generated was fake and so forth. You see, you can't do that on the DEX, because with the DEX, everything is on chain. You literally can see the liquidity pools provided by all the individual liquidity providers. You can also see basically the reserves. You can see the prices. Like basically, there's very little opportunity for somebody to do any monkey magic here.
And maybe also to add, there is the point that is all visible. You see actually what's happening, but it's also dictated by algorithms. It's very deterministic. A little bit along the lines of what you talked about AI agents earlier. We might go into a phase where things even like a DEX would not be 100% deterministic anymore, because AI agents would make probabilistic decisions more like a human. If that's good or bad, up for debate. Not necessarily the topic here, but an interesting side track of that. But yeah, basically there has to be full reserve, because the algorithm dictates such. You cannot have fractional reserve if it's not baked into the algorithm, and that is usually open source, and you see what the protocol is doing on chain, so people would find out. You mentioned on-ramping. Talking about that, let's imagine a future where centralized exchanges would be gone, because it's all done on-chain on a DEX. Now we still have a fiat world. Who knows when it breaks apart, or if it ever will. But let's say at this point in time, most of the money is outside of blockchain. So how would you see the on-ramping and off-ramping in a world without a centralized exchange? And in how far do you think will newbies, as you described yourself, when you just joined this field, it was really, you didn't really know what a wallet is, how it works. DEXs, in my personal experience, tend to still be more technical and harder to use than a centralized exchange. That's obviously fixable. That's a question of people that create those DEXs, creating them in a different way. But at the moment, that's a fact. And the question is, how do you see newcomers into the field, not only on-ramping their money outside of blockchain, but also getting more familiar with the industry if centralized exchanges wouldn't be a thing?
Yeah. Okay, that's like 4 different questions there. I'll start with the second last one, which is access. We're talking about access. How accessible is the entire Web3 ecosystem to somebody who's off-chain, right? And the thing is that one of the best reasons for CXs to exist is essentially on-ramping and off-ramping. And you're right. I mean, we're still living in largely a fiat world. So for me to, most of the time, and from 2018 up to possibly even last year, I still had to off-ramp from my wallet in order to pay for goods and services. That is beginning to change. So quickly touching on the accessibility, CXs was the first organizations in the Web3 space to actually allow programmatic access, which means they had an API. So the thing is that the first API I remember coming from a DEX was Paraswap, and frankly, the API was quite slow and poorly documented. I mean, now things are different, but when I tried to play with it, and so the thing is that why is this important? An API is an application protocol interface, yeah, and that connects 2 pieces of software together between 2 endpoints. All right, just for the non-technical listeners. And the thing is that CXs providing APIs actually expanded the ecosystem vastly. And so that allowed market makers to come in. And market makers provide volume. And you also allow liquidity providers, and last but not least, traders. Okay, and I frankly believe that the trading activity on chain is actually what is creating a lot of adoption right now, especially with institutions coming in. They're not going to human manual trade anymore. That's basically a very outdated way of actually trying to make money from investing. Okay, so the majority of hedge funds, as well as financial institutions, and I mean even entities like MicroStrategy, they are using algorithmic trading, and algorithmic trading requires the trade to execute like programmatically. It needs to basically be done even when the human trader is asleep, and CEXs actually provided that. That's number one reason that they actually helped the accessibility by actually opening up these developer tools. The second thing is liquidity. Now, to actually let people come on board chain, you actually need to have a large reserve of fiat, or so we think after the FTX scandal. Okay, you need both a large reserve of fiat and a large reserve of coins. And the fact is that this actually, if you try to go into a DEX and exchange for tokens, most of the time, if nobody's providing liquidity for that particular pair, what are you going to get? You're going to get something called price impact. And you're going to get a second thing, which is called slippage. And this hurts. That means, for example, if I trade $100 of Ethereum for $100 of Dogecoin, I should get $100 of Dogecoin. But no, because of a lack of liquidity providers, firstly, the price gets skewed. You probably lose a lot to the price impact. So, and the second thing you lose it from is the slippage. So basically, you're sitting around waiting for the other side of the transaction to complete. Whereas CEXs, they have so many traders at all times, and they can actually synthetically even create the trade. So that's called a maker transaction, right? And then the thing is that obviously, if somebody else is on the other side, it's called a taker transaction. But we're not going to go too deep into the technicals here. So let me just wrap up the accessibility side. So that's basically how CEXs provide accessibility. Now you're also talking about how do you think new users are going to onboard in a CEXless world? Now, there are two things about this question. Number one is that there is a paradigm shift in which services like Travala, they're selling travel products like plane tickets, hotels. I think they're even getting into attractions now. They're becoming the biggest OTA in the web space. They directly accept crypto. So that there's actually no need for the user to off-ramp anymore. So these types of services are going to be the ones advocating new users to actually survive in a CEXless world. So the other one is, of course, payment gateways like MoonPay, like HelioPay, even Crypto.com, which is a CEX, but I believe they started from a payment gateway. And they're actually allowing people to actually pay in fiat and get crypto, but they are doing it in a single unified process, meaning that you can pay with either fiat, you can pay with crypto, and you still get the concert ticket, your goods and services. There is a startup which I seen recently. They're called Hamza. They're trying to build a on-chain Amazon. That means basically you can buy your gadgets, your t-shirts and all that, and it's entirely an entire Amazon experience. It's basically, it makes me think, why isn't Amazon doing this? Because they have a lot to lose. They have a lot to lose from decentralization. So I hope that answered how things are going to look like in a CEXless world, is people actually having access to services that totally bypass the need of off-ramping. And the second thing is payment gateways actually bridge the gap, because payment gateways are a little bit more agile than CEXs, because CEXs are now being hampered by an enormous amount of compliance, especially now that you know that CZ from Binance actually went to jail because of several breaches. You're not supposed to be doing certain things in the American market, but he was. He's now done his time. He's now out again, and now Richard Teng's in charge of Binance, and it looks like the same process is happening again. Okay, so the last part of the question, that was not the accessibility one, it's not the CEXs world, it's the education, right? So there actually has been a bit of a renaissance of blockchain media. So the thing is that I'm just plugging one of my startups, by the way. Red Survivor is also a fantastic blockchain media, but there's also Cointelegraph, there's Coindesk.com, who's running consensus conferences. And the fact that we have a healthy conference circuit, we actually have more than enough major events in the yearly calendar to actually pretty much keep you busy year round. And those conferences are now outpacing Web 2 conferences. People are no longer interested to go into Web 2 conferences anymore. The joke is Web 2 vendors and Web 2 brands are now coming to Web 3 conferences and buying the speaker slots and buying the sponsorships and so on.
And that's really interesting. So basically your vision in parts, and correct me if I'm wrong, would be that the function that centralized exchanges, CEXs, CEXs, whatever you prefer, would be limited to a role of pure on-ramp
Off-ramp.
and off-ramp, either way, right? For somebody that is new to the space, you just need to get some fiat in. Once it's done, you can do whatever with it, with the crypto you have. You don't need the whole exchange system because you can then swap between different coins on chain. Basically, you would probably, thinking about it, would make sense that this would just strictly be fiat to stable coins, and then you would start trading into whatever. Could be a version of this. But if I hear correctly, and correct me if I'm wrong, and I understood everything completely, you would foresee a future where CEXs play a much smaller role and probably would vanish eventually. Is that realistic, though? Is it something you mentioned how much capital is locked in these institutions? Those are big, big companies. FTX, again, burned 20 billion or what the exact number was. A lot of that in their own token. Talking about creating value out of nothing sounds very central bankish. It didn't go well for either, it seems. But a lot of it was also in tokens that was given to them in custody by people that trusted the second biggest exchange in the world, which it was at the time. We always need to remember this. It's crazy what happened there. And then the leadership of that centralized exchange used it to gamble with it, basically. They had a market maker on the side and a hedge fund on the side, and they would basically do some non-optimal trading decisions, let's put it that way. Yes. And that's where a lot of the money of people of all categories, people that just put in $10 to play with, people that had millions stored on their exchange. I know people that hundreds of thousands on there just for the interest they would get in storing it there. And all that was gone. So in a future where that would all be gone, that would also mean all this wealth that is stored still in centralized exchanges would have to move somehow on-chain. Do you see a problem with that, or how do you see that process shaping out in your own personal opinion? Obviously, we can't predict the future, but we can make an attempt on it.
Oh, yes. I like this question. Okay, I have a lot to say about this, actually. So, okay, CEXs, right? I mean, how will they operate, and will their role become diminished as such? Actually, there's one element that we didn't talk about so far, and that is lending. So the fact is that CEXs are still actually the best position to actually lend the most amount of resources. And don't forget, if you go on to like DEXs, so DEXs are beginning to catch up now, they don't have leverage. A lot of DEXs cannot provide leverage simply because they don't actually have a deep enough liquidity reserve to actually allow users, because otherwise you would liquidate the exchange itself, right? So most of the positions which allow leverage on DEXs are restricted to like maybe 3x. The highest I've ever seen in my life was 1,000x leverage on PancakeSwap, the largest DEX on Binance chain. But the relationship between PancakeSwap and Binance itself is a little bit gray. So you see, that could be somebody else's liquidity they're using. And frankly, we don't know. And the fact is that leverage is one of those things that actually allow, we're now approaching on-chain entrepreneurship. You need to actually be able to lend people money for them to actually take risks. Otherwise,
Maybe if you could quickly elaborate a little bit on leverage trading. What does that actually mean? Because not everybody might be familiar. And why a bigger liquidity pool would be required for it, if you can quickly touch on that, and then I think elaborate more on that line of thinking.
Okay, so with leverage trading, basically what the user does is they're trying to play with a larger position than they would have normally. So the fact is that if I'm using, let's say, a 10x leverage, so if I had $100 and I was having a spot trade, which is no leverage, and my trade increased by 2%, means I have a 2% profit, I will make $2. Whereas a user that applies leverage with 10x, if his trade was to go up by 2%, he would be 20% in profit. So the fact is that this makes it very attractive for usually, and I'm sad to say this, a lot of retail investors do tend to gamble on leverage. And the fact is that the leverage is usually derived from the user's own position, and this is called an isolated margin. or use a cross-margin position in which they're actually using their entire volume. Now, cross-margin positions I have only seen on Hyperliquid, which is actually an Arbitrum. Is it an Arbitrum layer 2 or is it a layer 1? I'm confused. I think it's a layer 1, but you just have to bridge into Hyperliquid. Hyperliquid is a DEX which actually has professional trading tools and leverage on it. And the thing is that I'm a big fan because so far it's giving me the best CX experience, but on a DEX. And the fact is that quite famously, if you go to a CX, you'll quickly notice that you can do a lot of different pairs, whereas DEXs are pretty limited, and they're limited by the people who are fractionally giving the liquidity to that specific pair, which is a problem. I know we're getting a little bit deep here. So the thing is that with CXs, there's one more thing you can do, and now we're getting a little bit esoteric, which is, of course, inverse pairs, which means, for example, I normally trade USDT, BTC. So you're using denominations of USDT to trade BTC. But actually, if you are using a centralized exchange such as Bybit, you can actually do inverse pairs, which means I want to take my profit, for example, in Bitcoin. I don't want to take it in USDT. So I will go BTC Sol, for instance. So I'm trading Sol, but denominated in BTC. And when I make a profit or loss, I will basically be denominated in BTC. And some people who are maximalists of Bitcoin or some other coins, they like to do this a lot. And this is something I've yet to see happen in DEX, right? Okay, so going back to the main point here is that lending and leverage, and that's how leverage works. Leverage is simply an application of lending where you're borrowing money from the exchange's liquidity to execute a leveraged trade. And obviously you increase your risk significantly. Now, what was the other part of your question? In
terms of how and how far. So the question evolved around how the money that's still stored in exchanges, how you would foresee a future where that would move out of those centralized exchanges. And I mean, obviously, leverage trading is a really good point because that's, as you say, predominantly in centralized.
Yeah. So that's still predominant in centralized exchanges, and how would the majority of those results? Eventually, I foresee a lot of CX liquidity to start going on chain, and then once those users are on chain, they can simply swap on all DEXs, swap between themselves, do P2P, which is actually the spirit of crypto. The whole point why Satoshi wrote that paper was simply in a world without banks. But as you do know that people like being rich, and the CXs are now resembling traditional banks more and more. And the fact is that I don't believe their role will be dramatically reduced, but it's beginning to reduce because certain services are beginning to replace, for example, providing leverage, providing lending. The famous lending protocols like Aave. It's a multi-billion-dollar protocol. It exists across several chains. And if you're not using your tokens, for example, I have a bunch of BTC. I don't want to spend my BTC. I will stake my BTC into the Aave protocol. And that is on-chain, and it's trustless, meaning that nobody from the Aave team can compromise that contract and take my BTC out, which is what a centralized exchange can do, by the way, because it's not custodized, because it's still my coins, but it's just being held trustlessly in a smart contract. And then I can actually borrow against it. I borrow some USDT off it and use that USDT to trade, which is right now described as one of the best practices. And I believe that using on-chain lending protocols is actually going to start pushing more and more of that volume onto chain native, so to speak. Yeah. So one of the last things I want to touch on here is that, how to put it, with CX, right? They also provide one particular service, which is KYC. The thing is that most DEXs have no incentive to KYC at all. Because the fact is that the whole spirit of crypto was to be self-sovereign, it was to be anonymous, be totally private. But then again, you see now this is where you start to overlap with social good. So what if you had a genocidal mass murderer who's trying to exchange his coins and buy a whole lot of weapons, right? In fact, is that a CX could stop that because they could go, okay, this account is now banned. Meanwhile, a DEX won't do that. A DEX can't do that. Because the contracts are already written, the contracts are already deployed. You can't update the contract unless you deploy a new version of the contract. And obviously the bad actors won't find themselves going into that token. And sorry, I forgot to mention staking. I actually lost a bit of money with FTX because I was actually staked into one of their pools. and staking locks up your funds for a certain period of time. Staking can still also be done on DEXs, but on CEXs, this is where it gets a bit murky. Because when you actually stake your tokens into CX and it's both staked and custodized, that's when I realized, hang on a second, this isn't my money anymore. And that's how I lost money. I basically saw FTX crash before my eyes, and I couldn't get out of my stake.
Yeah, I mean, at that point, it isn't really staking in a sense. It would be described in a... So maybe also for those that are not familiar with the concept, staking is fulfilling a purpose on a blockchain originally. That proof of stake is a architecture for blockchains, and the purpose is that you put a certain value in there. It has to be provided to be part of the blockchain. So a tag on that blockchain would require for you to basically buy more than 50% of the complete value of the coin of the blockchain, and then take over those nodes and control of the blockchain. That's the idea of proof of stake. Staking has a purpose, and it has to be your money, otherwise the purpose wouldn't be fulfilled. And calling it staking on a centralized exchange is actually kind of paradoxical. It doesn't make a heck of a lot of sense.
No, they're just stopping you from thinking.
Yeah, yes, exactly. It's basically just a savings protocol. It's like a savings account on.
They could change it.
Yeah, yeah. I mean, everything. That's the thing on a centralized exchange. FTX proved it. You have to expect the worst, and they are less regulated than banks. I'm not a big fan of regulation, but if humans, as you say, they like to be rich, you better regulate that. That's why a DEX, in my opinion, and I agree with you completely there, is a wonderful tool because it's not governed by humans, it's governed by algorithms. And they usually don't care about being greedy. Once we go into the AI space, that's all changes again, but at this point in time, that's what it is. We are running out of time, but this was extremely insightful. Maybe you can say a word or two about your next few days on Block Mountain. I think you're pretty busy. Maybe some of our audience is around, and you can say a few words about the events you're running in your own space. And everybody, you know, there is one of our events here this evening, but there is more to come. So if you happen to have time, Mark, a little promotion.
Yeah, promotion? Well, actually not. In this case, I would actually be promoting the people that hired Frying Fish Club, which is the restaurant in Chiang Mai. Sells fantastic fish and chips. You should try it out. And we're just playing host. So tomorrow we actually have a DeFi meetup. And this was actually sponsored by T-Pro, which is a analysis protocol, Monstro.fun, Rex Survivor, Bebop, and ThanksNet, which is a Japanese private chain as a service provider. So if you're interested to learn a little bit more about what we just discussed about DEXs, DeFi, in fact, I'm going to show my personal stack of how to actually generate 150 to 200 US dollars a day just by yield farming purely on decentralized exchanges. I'll be showing a live demonstration on level 2, and I think that event starts tomorrow at 4 p.m. And tomorrow is going to be the busiest day of Block Mountain because there are 4 side events running almost simultaneously. I hope you come to ours, which is of course the DeFi meetup in Frying Fish Club, 4 p.m. And later there is a meme narrative meetup at Yellow co-working space.
I'll be speaking there.
And Jan Hanken is going to be speaking there tomorrow at around 7 p.m. And after that, basically on the Friday would be the 24th, we actually have a DCOM, Decentralized Commerce, which is actually done by Hamza. The website for that is hamza.market. And those are the guys who are trying to build a decentralized Amazon. So that's a pretty exciting topic because, frankly, I don't know very much about it. So DCOM is completely new because unlike Amazon or Lazada or Shopee, you don't have a bunch of VCs just owning the entire system. And this system is actually owned by merchants and users, which is actually quite interesting, don't you think? And obviously, they're going to have an after party in the same venue, and there's going to be free flow draft beer. It's Asahi. It's pretty nice. And the following day, which is on the Saturday, we're having Asahi right now, me and Jan. On the 25th, there's going to be what I would describe as the best ending party for Block Mountain. Of course, please go and visit the main conference, which is on between 23 to 26 at Niman Plaza. But bear in mind that most of the content of the Block Mountain is going to be in Thai language. So you could use AI Translate or just focus on meeting people rather than the sessions, because you won't be able to but Block Mountain does a pretty good job of like uploading all their sessions anyway. So you can probably use AI Transcribe for that. Last but not least, the party 25th, Frying Fish Club again, starts at 7 p.m., goes pretty late. And that one has DJ Lou Jane. I believe she's Kuwaiti, but from Bangkok. And then you have DJ Moon Asset. He's from Korea. And he's also representing a collection of projects from T-Pro to TTM Ventures, as well as Aether, AETR. I believe that they are a decentralized physical infrastructure, DePIN. They are DePIN project, one of the most famous ones in the world. And I think there's a rumor that the co-founder of Aether will actually be here as well. So you can actually meet some pretty interesting people.
Awesome. I think that wraps it up quite nicely. For our event, we will have one at 4 p.m. in the city, and then a big after party here in FFC after that. Looking forward to see some of you there. And outside of that, there will be our next podcast. I'm looking to our head of marketing who plans these things. 5th or 6th? 6th of February. Topic will be, who's our guest? I'm horribly prepared. Say again? RWA with Rajesh. That's going to be an interesting one as well. Looking forward to see you all there again. And as always, this will pop up on YouTube within the next few days. And feel free to ask questions on the channel. See you next time on the 6th of February. Bye-bye.